Good morning, trading world. It is September 16th, 2022, 8:51 a.m. on the East Coast, and this is my pre-market outlook and technical analysis for day trading the SPY. The title for today's pre-market: The market worsens as attention shifts to the Fed. I think I may have said it a while back that eventually the Fed will push and push until something breaks. It looks like we are on that verge of breaking both the equity markets and the real estate market. I have spoken about how the rising cost to borrow is wreaking havoc on PE ratios and exposing zombie companies. How does this break and or reset the real estate market? Well, believe it or not, only about 25% of homes are bought via cash. A study done by Redfin and published in the Washington Post says recent analysis by Redfin real estate brokerage found nearly 1/3 of all home purchases between January 1st and April 30th, 2021 were completed with cash. That compares to 25.3% of purchases for the entire year of 2020 and is the largest share of cash purchases since 2014, when 30.6% of homes were purchased with cash. Now, assuming the other 70% of homes are purchased using some form of a mortgage, this is where the interest rates come into play. Due to huge demand, property values have skyrocketed. Let me bring up some facts. All right, this is a chart of historical median home value. And if we go back to 2017, the median home price adjusted for CPI, which is inflation, is $274,000. We round it off to that. Now, let's compare it to what it is or was in 2021 as close to current as we can. Adjusted for inflation, the median home price in 2021 has shot up to $394,000. Now, we know that there was a huge demand for homes. We know that leading up to the pandemic, the supply of homes had been dwindling for years before the pandemic. Add the pandemic in and it shut things down and made that supply even more, what's the word that I'm looking for here? Even more, I hate to say it, but small. So now you have lots of people fighting over a very rare or small amount of homes, which, if you took anything in economics at all, you understand supply and demand. The rarer the supply, the higher the demand, the higher the price. Now again, 70% of people must qualify for a mortgage based on monthly payment. And if everything is out of reach, this brings the housing market to a very interesting intersection. Let's go back and calculate the payments. Before we calculate the payments, let's take a look at what interest rates have done in recent history. This is a chart of the 30-year fixed rate mortgages from 1971 to 2022. But let's pay attention to the 2020s and 2022, and this last sentence is really important. Rates spent most of 2021 between 2.7 and 3.1%, giving many borrowers an opportunity to refinance, buy homes at the lowest rates ever recorded. Now, 2022. The Consumer Price Index, that's what I just talked about, the CPI, an important gauge of consumer inflation, increased by 8.5%, the largest 12-month spike since 1981. Rates already headed higher before the inflation report started the year off at 3.45%. In January, they've steadily risen each month in 2022, with the U.S. weekly average 30-year fixed rate rising to 5.3%. So, when we consider all of this, a mortgage on $274,000 just 3 years ago would have had a payment of $1,377 and change. Now that same $274,000 mortgage at today's rates would be $1,778 and some change. However, today you can't find a house for that $274K. That same house that cost $274K in 2017 is now $394,000. And the payment for that $394,000 home is now $2,557 and change. That's almost double. Now again, 70% of people must qualify for a mortgage based on monthly payment. And if everything is out of reach, the housing market will have no choice but to depreciate from here. Now on the investor side, cap rate rules. And the rule of thumb is 1% of overall cost of the home is what investors aim to capture for rents. Who thinks 1% of home price in your area is fair rent? I don't. So regardless of how small supply is compared to demand, the real estate market is bound to take a huge step back due to the Fed and continued rate hikes. Let me bring up the Fed Watch tool. All right, now we have the Fed Watch tool in front of us, and they've done an excellent job in tracking the probabilities of the rate hikes in the Fed meeting that we have coming up. The next one is next week. So in looking at this, it says we have an 80% probability of a 75 basis point rate hike. The whole purpose of the rate hikes are to fight inflation. And according to the last CPI print, we are nowhere near getting inflation under control. From this, the causes may have been different in 2007 and 2008, but where we end up could be exactly the same or worse. All right. Looking at where we are right now, it takes me back to the pre-market I did September 14th. In that pre-market, I talked about breaking the lows overnight Thursday. Here's the quote. Thursday going into Friday overnight, we get a huge scare and break the lows a bit because of overnight news from Europe. Once the U.S. market opens on Friday, we begin to level off, consolidate, and gamma risk teamed with short covering starts a huge rally, similar in nature of that of a blow-off top. End quote. Today, keep a close eye on the dollar. If it continues to approach a breakout higher, markets go for new lows. And if the dollar settles and fades, we could possibly get that big pop or rally similar to a blow-off top. But right now, as angry as the market looks, we could really go for it today, where we hit that capitulation or all-out scare and panic, where people start redemptions and start calling retirement funds saying, get me out at any price. That's when the panic comes. That's when it's possible to start looking for a bottom. But before we can even start looking for that bottom, I talked about contango versus backwardation. And so I have to do this in another screen, but I want to bring up the VIX right now, the VIX futures. All right, this is a bit off the cuff just because I had out of the corner of my eye, I saw the market kind of breaking lower pre-market. So I wanted to take a look at where we are as it stands with contango and backwardation of the volatility futures. And the contract to pay attention to is 33 days out, because if you can see where we are, the 5-day, 12-day, 26, it doesn't mean anything. So looking at 33 days out, we're at 28.1. And we're just 5 basis points away from backwardation. And actually, if you look further out, we're already on even playing field with 96 days out, the D22 contract. So what this is saying, we're coming up on that trouble. We might not be in the eye of the storm at this very moment, but it's getting closer. So I just wanted to bring that up before I get into the levels of the day, because this is going to be very important. Something that you're going to have to keep your eye on, because when it crosses over, that's when we know we're in the storm. And that cross back over could be the first sign of nearing a bottom. So I don't expect it to all happen in one day, but we're close. Let me bring up the levels to watch for today. All right, here we are back with the key levels to watch for today. On the resistance side, we have the Jack resistance, 386 to the 387 area. We have Queen resistance, 388 to the 390 area, and then King resistance, 391 to 404 area. Remember, there's a lot of gamma risk built up. We have a triple witching, which means a lot of expirations, 3 different expirations. with a lot of open interest, and that could carry us a long way today, either up or down. On the support side, we have our jack support at 384 to the 383 level. Our queen support, 382 to the 380 level. Then we have our king support, which is rather large, 379 all the way down to 362. The reason those levels are quite large today is because we're at a breaking point. We're already outside of the market maker's expected move. So professional money managers, if we continue lower, they have to dynamically hedge by selling into the selling. They will start selling futures like it is no tomorrow. And they will continue to do this as long as we sink lower. The main thesis for today was bullish, closing above the 390.12 with a projected target high of between 391 and 403. On days like this, the alternate, more explosive thesis is bearish, closing below the 390.12 with a projected target low of between 389 and 379. The current major channel we are in is 397 down to 379. The major channel below that is 379 down to 364. We have huge imbalances above, along with huge gamma risk. So the first domino to fall is large amounts of short covering. If this happens, blink and it's possible you could miss a jump back towards 400. Then there's another possibility we could drop even lower at midway point today. Let's hurry up and get into the scenarios of the day. Sorry, I'm running behind this morning. Right. Our first and most probable scenario is going to be our trend day down structure. It will be a rather unusual trend day down, being that we have so much open ground to cover today. On our trend day down structure, we open, gap down, and start with a pop back towards the previous close. It's going to feel like a serious rally. We find resistance on or before that previous close, then begin the downtrend for the day. However, instead of the normal golden window that happens at that kind of 10 to 11:30-ish time frame, it could be very different today. We find midday chop around either the possible queen or king support. Again, this could make for a very unusual day. Instead of a midday chop that we normally get today, and this pretty much goes for all of the scenarios, instead of that midday chop, we could pretty much find ourselves in a midday drop. So be very careful about that today. If we get a sharp midday drop, it could be very likely that we kind of see a temporary V-shaped bottom where we start a sharp rise back up heading into the close, and this will be the gamma risk and that short covering combined, speeding us or jumping us back up towards the bottom edge of the market maker's expected move, and that's around that 397 area, I believe. Let me make sure. Actually, it's around the 395 area. So we could make a run back towards that. So this is our trend day down, highest probability of happening today, 37%. All right, our second most probable scenario is going to be our rounded reversal day type structure. We could get a continued push higher toward the Jack or Queen resistance area, find midday chop around either that Jack or Queen resistance before spending the same energy we used going up to go back down the second half of the day. Again, today will be unusual. That midday chop that we usually find, it could turn out to be a midday drop. So keep that in your mind. Be prepared for that. And that definitely changes the look of our rounded reversal day type. I also want to put you on notice of a vice versa. We could have a vice versa alert. Instead of a continued push higher, we could come out with a continued push lower. And that continued push lower could look like this. And that could be our rounded reversal day type structure, where we get the continued push lower, find our midday chop zone, but instead of it being a midday chop, we could have a midday drop and then continue back higher, giving us a rally into the close today. So that's our rounded reversal day type structure. All right, our last scenario, forgive me because I'm rushing through this, is our expansive range day structure. We could have an initial pop up, find resistance, and chop back and forth, then hit a sharp reversal, retesting overnight lows and possibly pushing through them before making a V-type reversal up towards the latter part of the session. So this is our expansive range day structure. Today is definitely not a day you want to play around. You must have your risk in check. And if you were like me and got short, I was carrying short positions even before yesterday's close, but had the mindset to add additional short positions at yesterday's close. If you're carrying those shorts, you want to give maybe 5 or 10 minutes, kind of look how things are on the open and take half of those profits right then or pretty soon after the open, because we could pretty much be on a wild ride where we could go get, or the market could take all of that back very soon. So you want to lock in profits quickly today. Again, as I say each day, your most important job as a trader is to protect the capital that you already have. We do that by knowing and understanding risk and managing that risk by or in accordance to our account size. I hope this helps. I went on a tangent because I'm doing a lot of stuff in real estate right now, so it just made sense for me to go into this tangent about rates in the real estate market. But again, I hope this helps. As always, wishing you a positive trading day. Make it a great one.